Hello and welcome to PriSim Business War Games video overview of a financial perspective on vehicle and equipment dealership operations. And in the video we're going to review a couple of common financial transactions that vehicle and equipment dealers encounter as they run their business. So we'll run through a couple of exercises that illustrate the flow of money through a dealership's financials. And we'll give you some next steps to continue to develop your understanding of finance. So, why is finance important? Why spend any time on this stuff? Well, everyone at a dealership should understand the impact of their actions on the finances of the business. In every department, people need to speak the language of business, not just at the general management level of the organization. And it turns out that finance is really more logic than math skills, so everyone can and should understand the basics. And there's accounting that's happening behind the scenes of every transaction that occurs at a dealership. And how the company keeps track of it all becomes very important to the success of the organization. And we'll illustrate that in the examples that we have in this video. And you can take a look at two background or overview videos that we've also made that cover the income statement, the balance sheet, and common financial ratios. And you can see the link here. Okay, let's get right into it. We're going to show you a couple of examples that demonstrate the flow of money through a dealership. And here's a game board that we'll be using for our two scenarios. And we've got a high-level income statement and balance sheet depicted here on the board. In the real world, the statements have a lot more detail, but we've simplified them to help illustrate the points in our exercises. So you can see the balance sheet and the income statement, some of the line items. On the balance sheet, you see the assets on the left-hand side, and then liabilities and equity together on the right-hand side of the balance sheet. You see the line items for the income statement, or profit and loss statement, as it's sometimes known. And the green coins that you see depicted, we're going to be moving those around on the statements. And we'll say that these are worth $1,000 each in our first scenario. First, let's set up the financial statements for the current condition of the company. And in this case, we'll say that our dealership has $2,000 in cash, $8,000 in stock, and $6,000 in retained earnings that haven't been paid out as distributions or dividends but retained in the business. And that currently the company has two mini skid steer excavator backhoe attachments currently in inventory that cost $6,000 each when they were acquired. And if we set that up on our game board, you can see that we have $2,000 in cash. That's an asset. We've got equity capital stock of $8,000, and then we also said that we had also in equity retained earnings of $6,000, and then we have the two backhoe attachments, $6,000 each. That's an asset, that's inventory, and the balance sheet balances with $14,000 in assets, and then combined liabilities and equity also of $14,000. Now let's go ahead and actually sell something and see how the financials are impacted. So let's say that we sell one of those backhoe attachments and we sell it for $10,000 even though it cost of goods sold was $6,000. We'll say though that we had to pay SG&A, so selling general and administrative expenses of $1,000 in cash, and that we had to pay taxes of $1,000 also in cash. And we'll take a look at how the financials look at the end of the year. And now let's play it out through the financial statements, and here you see the starting point, current condition of our company, our dealership. So I'm going to go through these slowly so you can think through this scenario and how you'd like to answer it before I actually move the coins. And of course you can pause the video and play it out more fully yourself before you then watch how I do it. So the first thing that happens is we sell this backhoe attachment for $10,000, and I want to make the point here that that $10,000 we say that it's cash, but not in every case is revenue always cash. Cash is cash, but sometimes revenue could be in the form of an account receivable. If you don't receive cash from the customer right away, maybe they've made a promise to pay the cash at some future point, maybe 30 days from now. So revenue and the resulting profit that comes out of it are accounting concepts. They may or may not always be the same as cash. It really depends. So in this case, we say we have the $10,000 in revenue, but also it actually is $10,000 in cash. So we show that as an increase in our cash account as an asset. And then we said that, okay, we've sold one of these backhoe attachments, so that inventory amount is now converted into COGS. We've sold it. It's not inventory anymore. It's actually cost of goods sold. We're going to match that. Matching principle in accounting says we match the revenue to the expenses in the period in which we're trying to determine the profit. And so in this case, that's an example of the matching principle. We've matched the $6,000 in our direct cost for that backhoe attachment against now the $10,000 that we got as revenue from the customer that bought it. But wait, there's more. Because we also have what? We have SG&A, we said, of $1,000 in cash, so our cash goes down by $1,000, and we now have an SG&A expense on the income statement of $1,000. Then we said as well, same idea here with taxes. We paid cash for taxes, $1,000. That's now reduction in cash on the balance sheet, but also we have that as an expense on the income statement, with the result that now our income statement shows us a positive profit once we work through the math of $2,000. And that's great on the income statement, seems to make sense. But what about the balance sheet? We have, on the one hand, we have now assets of $16,000 between cash and inventory, but on the other side of the balance sheet, it doesn't seem to balance. Right, we still have the 14 that we started with between the capital stock and retained earnings. So what changes? How do we make this balance? Well, maybe you've done this already as you thought through the example. We need to bring over that net income. Anytime we have net income at a company, if we don't pay that out as a dividend, a distribution, it would then increase the retained earnings amount, such that now if we do that, balance sheet balances, and we have $16,000 on each side of the balance sheet. Okay, for our next scenario, we're actually going to make the coins now worth $100,000 instead of $1,000. So a little bit of magic we're going to go through here just to make the scenarios play out a little bit better within the slides that we're showing you. So the coins are worth $100,000 each, and let's go ahead and borrow some money from some friends. And we're going to borrow $1 million in cash from some friends that we have, very good friends apparently, at 0% interest, and we're going to borrow that on January 1st. Now obviously I'm creating some very specific details around the scenario to make sure that we can focus on the content of what we're trying to discuss here. So follow along and suspend your disbelief for a moment as we play out the scenario. We're going to borrow some money, and then we're also going to buy a mid-duty dynamometer to do some testing at the dealership on some equipment. And we're going to spend $1 million in cash on January 1st to buy that dynamometer. We're going to depreciate the dynamometer straight line over 10 years. So again, I'm being very specific in how we lay out this scenario. And then why don't we play through this using the same income statement and balance sheet to take a look at the financial statements and how they look at the end of the first year, and also how the statements would look at the end of the 10th year. So let's go ahead and play it out through the financial statements. And again, I'll do this kind of slowly so you can think through how you'd answer it before I actually move the coin. So there's our scenario in the bottom left. Let's play it through using the financial statements. So the first thing that I said is that I borrowed $1 million from friends And this is cash. I borrowed $1 million in cash. So there, our cash goes up by $1 million, and I've got that in 2 stacks of 500,000 each of these coins. But it's not only an asset. Right now the balance sheet doesn't balance. So what balances it? Well, at some point, 20 years from now, we have to pay back that 0% loan. But we actually have to pay it back. So we have long-term liability of also $1 million. And then what else do we do? Well, we don't leave that money sitting there in cash. We do what? We convert it immediately on the same day, it says here, January 1st, into a dynamometer. That's an asset, a long-term asset. It's going to fit on the line that says land, buildings, tools, etc. This is a piece of equipment we're going to use. And then, we're going to depreciate this asset as we use it. We don't just purchase the dynamometer and let it sit there. We're going to use it, so it's going to be depreciated or used up over its useful life. And we say that's a straight line depreciation over 10 years. So what happens when we do that? Let's say now we're at the end of the first year. We've used this dynamometer to do some testing. We've charged some customers for it, but we're going to keep this scenario very simple, just to focus on the depreciation aspect. But after the end of the first year, we have some depreciation, and that would actually be an expense. And if we say, hey, we've used up 1/10 of the value of that dynamometer, well, then in the first year, we've got to depreciate 1/10 of the value, the $1 million value of the dynamometer. So there's your 100,000. And also we have that 100,000 is represented on the balance sheet as a reduction in the value of that dynamometer. So we put that into accumulated depreciation. At this point, that's $100,000. So that asset is actually worth $900,000 now because we've used up 1/10 of the value. Now, if we play this out, at the end of the year, we're going to show on the income statement, all else being equal, assuming nothing else happened, we actually have that depreciation expense as a negative in terms of profit. So what happens? The balance sheet currently isn't balancing because if we have $900,000 over on the asset side, the liability and equity side has to balance with it. And what do? Well, you probably already thought this through, and we have now an impact of retained earnings. Even if we lose money in terms of profitability, it has an impact on retained earnings. So now in this case, the dynamometer has a net book value of $900,000, and we've got assets now worth $900,000, and also between our liabilities and equity, we have $900,000 as well. So it balances. And what about a case where now if we've gone through the 10 years and gone ahead and used up over the useful life of the dynamometer all the value of that dynamometer? How would things look? Well, you probably thought this through and done hopefully what I'm doing here, which is now we have, there's the other 900,000 in accumulated depreciation, because we're saying we've now over the useful life 10 years used it up. So that 900,000 adds to the original 100,000. You see I'm kind of stacking things there, but it equals the entire $1 million value of the long-term asset, which is now depreciated completely away. And then we've also, at that point, we would have also flowed through the income statement, another 9 times through each of the years, the $100,000 of depreciation flowing through as a negative to retained earnings, such that we've got a total of $1 million negative, all else being equal, in retained earnings. So in that case, the net book value of the dynamometer is worth 0, and also we've got between liabilities and equity 0 as well, so the balance sheet balances. All right, let's talk about what we covered in the exercises in this video. And as I said, everyone at a dealership should understand the impact of their actions on the finances. So one of the things that we talked about is that the balance sheet always balances, and that's the logic of how the statement is set up. It's not just the way the math happens to work out. And we saw too in the examples that profit doesn't always equal cash. It's not always the same thing. And there's accounting happening behind the scenes of every transaction that occurs at a dealership. and how the company keeps track of it all is very important to the organization. In the income statement, the balance sheet are integrated. They're two different lenses that you can use to look at the operations of the dealership. And also we learned that friends will give you a 0% loan. Well, maybe not. If you'd like to keep developing your understanding of finance, we've got a few ideas for you. We have 2 overview videos on YouTube, as I mentioned before, that cover the income statement, the balance sheet, and common financial ratios. You can see the link here. We also have some other references and tools on our PriSim website that you might find useful. Some planning tools, a customer lifetime value calculator. Also, we'd like to invite you to follow our PriSim group on LinkedIn, where we post a monthly business news item of interest. And if you'd like to take the next step and really bring some of these numbers alive in a training class for your company or your dealership, you can contact us about our test drive computer simulation, which models the operations of a heavy equipment dealership. And here's our email address. That's a quick video overview of a financial perspective on vehicle and equipment dealership operations. Thanks a lot for watching, and feel free to contact us through the email address here anytime. Thanks again.